Welcome to the Money Vikings Podcast, where we conquer financial freedom. Join Greg, Jerry, and Bob as they discuss everything investing and personal finance. The Money Vikings Podcast is hosted by three dads who are doing what they can each day to burn down debt and build wealth. Learn the path to true wealth. Their podcast and website, moneyvikings.com, is a treasure trove of ideas. So without further ado, here they are, the Money Vikings.
Hello, everyone. Welcome to the Money Vikings Podcast, show number 60. My partners in crime, Greg and Bob, have left me, Jerry, alone today to do this thing, as each of them have some prior obligations. But I think we'll get through this very nicely. So let's get right down to business. The most important thing that we need to talk about today is that the Matrix movie is coming out in 9 days. November 30th, 2021, and that is super exciting. And it has been a running joke on this show to bring that up. There is a little bit of a wrinkle and a combination of the fact that there is going to be a Matrix NFT that will be launched in conjunction with the movie. I know nothing about it. I am not endorsing it, but I thought it would just be interesting to bring up and see how that plays out. What else is going on, guys? Well, we have a Black Friday sale going on right now. We don't do these very often, but right now, if you use the code GOBBLE50, that's GOBBLE 50, when you sign up for your monthly Money Vikings premium subscription, you will get 50% off your first month. We're really excited about how the new premium service is going. There's been a lot of exciting and interesting conversations going on in our Discord. You'll also get a weekly newsletter, lots of technical indicators, and lots of articles, and time with Jerry, Bob, and Greg for any questions that you guys have on retirement, different portfolio management styles, different trading styles. All of us are very different types of traders and investors, so each of us has a different spin on things. Note that we are not financial advisors. However, we are happy to share with you what we're doing and things that have helped us grow our wealth over the past several decades. So please come by, check us out. If not, obviously, you know there's this free podcast, and there are many, many free articles on our website, moneyvikings.com, and also just a lot of fun things going on that we're anxious to share with you and talk about. Speaking of which, one of the big items that was just released to Money Vikings premium members this past week is called the Valhalla technical indicator, which Bob has put together. It's not just a technical indicator that tells you when to buy and when to sell. It's also kind of a backtesting tool as well that will allow you to see when it would have bought and sold various underlyings over the past several years, months, weeks, days, whatever time frame you want to do. It's very, very customizable, and you can kind of see how things would have played out in the past if you had followed it. And then in the future, you can use TradingView, have it installed on your own setup, and it will show you very simple yellow arrows that will tell you when to buy, it'll tell you when to sell. You can set up alerts against it, so when the direction changes, if you're looking to short something, you'll know when it would be a sell, or when you're looking to buy something or enter, it would tell you when it's a buy. And it takes into account many different technical indicators, combines them into one. So it's very simple, but there's a lot of tweaking that can be done in it in this version 1.0. There's some trend indicators. They have various colors, but at the very basic, nothing else. It's fantastic to have a Bob approved technical indicator buy sell signal that we now have for MVP Money Viking premium members. So we just had that 1.0 launch. We are getting positive feedback from members, and we will continue to tweak it and make updates to it moving forward. So that is one of many. There's a lot of different technical indicators that you get as part of being a Money Viking premium member, but this is probably one of the most exciting ones that we've developed yet, and there will be more to come. We are excited about this, and I just wanted to share that with you. We will probably do a deep dive on the Valhalla technical indicator and backtesting tool in a future episode when Bob is available to walk us through it. He has done a tutorial for Money Viking premium members so they can learn how to use it, configure it, change the colors, customize it to their heart's content. Moving on, let's talk about some of the trades that we've done this week. One of the industries that we are looking into right now is the solar industry. And we're looking at the solar industry through a vehicle ETF called TAN, T-A-N. And I've done a very simple trade with TAN that looks at going long on it. It's a bullish call spread. Very simple. It's a two-legged option strategy. And what am I doing? I am buying. So TAN right now at this very moment on November 21st, 2021 at 4:17 p.m. Pacific, it's Sunday. Markets have not opened yet. Future markets are open, so we can take a look at those in a moment. But for TAN, where it closed on Friday, was $98.12. And it was up about $3 on Friday, which was pretty cool. I entered this trade last week, and it's definitely starting to go in the correct direction. What I've done is I bought a December 17th 98 call, and for that I paid $4.75 for that per contract, so $475. And then I also sold at the same expiration a December 17th 100 call. So it's $2 wide. The call I bought is 98 and the call I sold is 100. Overall, I'm paying a debit on that. And the reason is because the amount that I've spent on the 98 call is less than the premium I take in on the 100 call. For that I collected $384. So at the end of the day, I was spending out of pocket 91 cents per contract, or $91 total, and I'm looking to make possibly the same amount back, basically a one-for-one, risk one to make one. So almost $100 I'll spend, and if the trade goes in the right direction, if TAN goes up to 100 or farther by December 17th expiration, I'll collect about $100. So kind of a fun little trade, not risking too much. You're not going to become a millionaire from doing that one, but it's a fun one. Get involved in the solar industry. It's an ETF, and one nice thing about doing options on ETFs is they're not as volatile as individual stocks. Anybody that went long on Rivian this past week or two knows exactly what I'm talking about. Another trade that we did was in Micron. I took a look at the entire semiconductor industry, and I took a look at the patterns that Micron was trading in, and it looked as if it was in either a triangle or a wedge, and recently broke out. And it's still below the rest of its peers in the SMH semiconductor ETF. So this is kind of a catch-up trade. And what I'm doing, also buying out to December 17th, I'm purchasing a 90 strike call, and I was able to purchase that for about $150, $1.51 per contract. I'm basically looking to see Micron continue to go up. If it exceeds 90, that would be fantastic. It hasn't exceeded 90 quite yet, but you can still make profit if it goes up a few bucks between now and December 17th. So that is a interesting one that we're looking at. If you are bullish Micron, this might be a very simple trade for you. A couple others that I've played this week, both kind of similar types of companies, Eli Lilly and Pfizer. We're big fans of Pfizer. We love the dividend. I can't speak to Lilly's dividend off the top of my head. But both of those I decided to go long using options this week, and both of those have done well. and I was able to open and close a few long call options. Typically, I'm doing those out to December 17th, and the reason so many of my trades are now landing on December 17th is that is the next monthly expiration period. I don't like to do weeklies as much as monthlies. Monthlies are a little bit more liquid, easier to get in and out of, easier to buy and sell. The spread, which is the difference between the bid and the ask price for those options, is much smaller, so it's easier to get in and out. I don't like to pay a tax, if you will, to get out of a trade or to get in a trade. So the more liquid these instruments are, you can actually help your chances of getting out at a price you're happy with by using the monthlies instead of the weeklies. The other reason is that I like to have about a month to 45 days out for all of my options transactions that I enter into. Mostly that's a rule that I follow when I'm selling options, because I do like to get out of those options at 21 days till expiration. It's been proven over time to show that that is the optimal time with Theta Decay, that you can probably do the best, get the best premium back from your transactions if you close them 21 days before they expire when you're selling. Buying is a completely different story and a different set of techniques. For buying, I often hold until the final day or day before expiration if I want to. But nothing wrong with that. I do like to take profits at about 50%. So generally when I'm selling, I will do 21 days, or I will do 50% of the premium received and close out the trade and move on. Roll, move it out to another month. Another trade that the Money Vikings premium members have participated in is Rivian. That stock has been on fire, and it IPO'd last week, went up really high, close to probably almost $200 if I recall. And now it's kind of coming back to earth, but it's still way out there. And I know Bob and many of the other premium members have been involved with purchasing options in those, mainly long call options, to try and capitalize on this amazing instrument. I don't know how long it's going to continue to be going to the moon, kind of like a crypto, but we'll see. The EV space is very hot right now, so we'll see, and we'll keep watching that. We've also been looking at Tesla as well. Tesla has gone through an interesting couple weeks. Elon Musk did a Twitter poll asking his followers if he should be selling some of his Tesla. Overwhelmingly, Twitter said yes, you should. And so he's been selling, sorry, did I say Twitter? I meant Tesla. Elon's been selling Tesla, and the stock has been falling a little bit, but it's very interesting. I don't think anybody thinks it's going to stay lower for too long. So there's been a lot of interesting scalping opportunities in those options. If you're in the Money Vikings premium Discord, you can follow along with Bob when he's in the bonfire, and with our other friends in there. They've been making some really good plays. I haven't done as many of those. I'm more of a options premium seller, but I did follow Bob on one Tesla option scalp, and let's just say my blood pressure went up quite a bit when I was in that trade for the whole, I don't know, 2 to 5 minutes I was in it. So it's kind of fun to try new things, learn different styles. I always recommend it, but do it only with money you can afford to lose. The other trades that I've been in for a while, I love to sell covered calls, as many of you know, and I've been really playing the sector spider ETFs. I've been playing XLI, I've been playing XLE, and those came up due for expiration. I've been in XLI and XLE covered calls for probably since the beginning of the year. And what's nice, so XLI is the industrial spider ETF, and XLE is the energy spider ETF. And those both pay dividends. So even if you're not in covered calls, every 3 months or so, you'll get a nice chunk of change deposited, and you can do DRIP, which is the dividend reinvestment program. So it basically takes the dividends that you receive from those and reinvests them. That's what I've been doing. So my share count's been growing slightly, which is kind of fun to see. But then also on top of that, I have been continuing to sell covered calls, monthly covered calls out to the monthly expirations, December 17th being the next one, over and over again. And so for those that weren't aware, Friday, November 19th was also a monthly expiration. So I wasn't sure exactly if I was going to be had any of those stocks called away or not. With XLI, I definitely did, and that was fine. That was a good thing. I had to I had to give my 100 shares to the purchaser of the call option, but my cost basis is incredible. I'm very happy with how it's done. And so now my decision is, after getting all that premium and probably have a few fractional shares or a share or two from the dividends, I have to decide, do I want to buy XLI again on Monday or maybe next year and start selling covered calls against it all over again? Totally something I could do, or I could leave it in cash, kind of wait for the end of the year, see how things go, or I could invest the money in something else. So that is a decision that I can make. In my mind, these covered calls, they're sort of almost like a Taoist investing style for me, where I don't know where XLI is going to end up 30 days from now. What I usually do is buy 30 delta out of the money calls, which means there's only a 30% chance or so that they will be above the strike. 70% chance they'll stay below. I usually go a couple strikes higher than where it's trading. Some people do at the money calls. I'm not a huge fan of those, but to each his own. You get more premium the closer to the money that you sell these calls. I like to go out a little bit. Like I said, the 30 delta, 30% chance of being assigned. And so I did that with XLI. I was assigned. I no longer have XLI. I did capture all the premium. With XLE, however, I thought I was going to be assigned as well. I was not, though. What happened was on Friday, the 19th of November, I ended up noticing that even though the strike price of XLE was higher than I expected, the value of the call, I could sell it and roll it out for another month to December 17th. So I did just that. I did not have to sell it. I got a very small profit from that last call that I sold for XLE and rolled it out. So what I did was I sold one of the calls to close. Sorry, I bought one of the calls to close, and then I sold another one out 30 days or so from now to December, and kind of wash, rinse, repeat, and try that again. Another covered call that I've been in for a while was SPG. That one has done phenomenal. The stock has just been on a tear for the last few months, and that was called away for me. That was that was actually a stock that I probably would have done way better off not having sold a call against it. The reason I say that is, although the stock appreciated from the cost basis that I purchased it at, and I collected premium and dividends for a few months, I would have collected way more by just owning the stock and selling it where it was on Friday if I wanted to, or continue to hold. I'm not complaining. Money is money. But if you look at the difference between what I collected on dividends and premium versus the appreciation from the cost basis that I entered and where it was on November 19th, you'll see what I mean. I could have made maybe a few $1,000s more than I did had I just bought SPG. But you don't know these things when you enter covered call positions. Generally, you want to look for a stock that isn't too volatile, because those types of things can happen, like it did with SPG. And you don't want a stock that is just sitting still either, because there's no volatility, and without that volatility, you're not going to collect any premium. So it's kind of it's a balancing act where you've got to find enough premium, and you want enough volatility that the premium is there, but you don't want so much that the stock is just going all over the place, like a ping pong ball bouncing around, or a BB in a microwave kind of thing. You want that slow, repeatable premium that you can collect. The other covered call I did was SoFi. SoFi, I thought, was going to be another one of these SPG scenarios where it was just going up and up and up. Obviously, it passed my strike, but not by much. And so I was happy with the way things ended with SoFi. It was a little bit above the strike. I did make a nice profit there. I have been rolling SoFi for 2 or 3 times, if I recall correctly. So each time I try to get at least 1% of the stock price in premium, at least 1%. Usually I can do a lot better than that. And I'll wait too. I don't necessarily like to just roll immediately and buy, just brainlessly buy the next month expiration. I'll take a look at the various strikes, the premiums, what they're offering, and I'll wait. I've had orders open to sell calls sometimes on stocks that I own for days, weeks. And if it doesn't get to that at least minimum criteria of 1% of the underlying stock price, I won't enter it. I played around with Joe, J-O, Cup of Joe, if you will. It's not J-O-E, it's J-O for the ETF. And if you haven't guessed already, that's coffee. And I've never traded coffee before. You can do that with futures, and there's different ways to play it. But in the account I have, they didn't have access to coffee futures directly. So I went with the next best thing, the ETF called JO. And if you bring up coffee and take a look at the last quarter or so, you'll see that it has been also on a tear. It went from probably about 200 up to 240 just this month in November. So I don't know if that's going to sustain or not. I'm completely out. I opened a small position, and every time it got to kind of a new threshold, I would take some profit, and now I'm completely out. So those are some of the trades I've done this past week, and it's been a lot of fun. I can't get enough of these trades. Moving on, the next area that we'll talk about is some of the different ways to think about these option strategies that we talk about a lot. Sometimes people will say, well, I want to do a butterfly or an iron condor or a covered call, but why are we picking these strategies? Not just because they sound cool and have interesting names. I like to kind of reverse things or invert things and try to look at the problem I'm trying to solve. So in my mind, each of these option strategies are solving a problem that I have that I'm looking for a solution for. So the first problem, category 1, is I have a stock that I own that I want to own. I like it. I'm happy with it. But lately, it's just not going anywhere and not doing anything. So obviously, one option is just to sell it and put that money somewhere else that you feel could generate more return. Another option that I like to do is just sell covered calls against it. There's a lot of stocks that I own that I plan to own for a long time. There's nothing wrong with them. They're good companies. They're paying dividends. They're growing, but they're not Rivians. They're not Teslas. And I just want to keep them. But while I'm holding them and keeping them, I'll sell covered calls against them. If nothing else, it makes it a little bit less boring to just own a stock outright. Obviously, there's risks that the stock could go down to zero, and you're kind of obligated to hold it or close the covered call you're in at a loss, or that the stock could go up like SPG did. in my case with one of the trades I've been doing for the past several months. But generally, if I have at least 100 shares of a stock, I'm always looking to see what those out of the money strikes at 30 delta are going to do for me. And sometimes they work out, sometimes they don't, but I like to always be checking. So at a minimum, if I can afford it, I will always buy 100 shares of a stock anytime I go in, and I'll always be looking for covered call options to see where they are. Another one I entered this week, I've owned 100 shares of silver, the ETF SLV, for a while. And I've sold calls against them, but for the last several months, I haven't sold any calls because the premium just wasn't there. And like I was talking about earlier, I noticed on Friday or Thursday that the premium had gone up for silver, probably because it's going to have a nice run into the end of the year, and it'll exceed my strike price, and I'll be sorry I sold that call. No, now I'm just kidding. But the premium did go up, and it kind of hit my target, so I decided, you know what? I want to continue to own. I want to have exposure in the precious metal space. I own some GLD, I own some SLV, I own some copper miners, and all of those, whenever I get the opportunity and I see enough premium at the 30 delta or lower, if I'm feeling really risky, I will sell those and just keep doing that over and over again as long as the premium's there. Another problem that options can solve for you is if you are on the fence about a stock. Let's say you're thinking you might want to buy Pfizer, but you're not sure if it's the right stock for you, or you think maybe Pfizer over $50 is a little bit more than maybe you want to spend. Let's say you feel like Pfizer at $48 is reasonable, and you'd be willing to go into Pfizer at 48, but not 50, not 51, not anything higher than that at this time. Well, if that's how you feel, you should take a look at cash secured puts. Cash secured puts are basically almost the opposite of covered calls. You are basically putting aside $4,800 in the Pfizer example that you have as kind of collateral in your brokerage account. You set that aside and you say to yourself, I will put this money aside and I will purchase Pfizer if it goes down to 48. So what are you doing to accomplish this? You are selling a $48 put against Pfizer, and for that you are collecting a premium. You might get paid let's just say $50. You're getting a little more, or $50, 1% of the stock price or better, as we said earlier. So for $50, you collect that. So that goes directly into your bank account immediately. There's no waiting for the option to expire. You get that money. It's deposited right away for every 100 shares of Pfizer stock you're willing to purchase at $48 a share. Keep in mind, these are lots of 100. So for one option you sell, one put that you sell against Pfizer at 48, you are telling the other party that you will buy Pfizer off them. They probably own Pfizer, and they're thinking, I don't know what they're thinking, but you are thinking of buying Pfizer. And so if it goes down to 48 by expiration, you will indeed automatically purchase Pfizer for $48. You will keep that, $48 a share, $4,800, and you will also keep that $48 or $50 premium, this fictional $50 premium that we talked about when you entered the trade. So you're actually kind of buying Pfizer at a discount in the future. Another way to think about a cash secured put is a limit order that you get paid for while you're in the trade. So you're just kind of moving along with life. That put that you sold is out there. You're watching Pfizer. Pfizer goes up, let's say to 60. Maybe you're sad. Maybe you wished you bought it at $50, but you collected $50 just for taking on that obligation to buy it later. And you can do that again. So if Pfizer goes to $60 and you're kicking yourself, well then maybe sell a cash secured put for $58 again, and just keep doing that until you get assigned the stock and you eventually own it. And then the cool thing is, once you get assigned the stock and you own it, you turn that around and you start selling covered calls against it. So if you got assigned, in my first example, Pfizer, and you were willing to buy it at $48, it went down to, let's say, to $47.50. So you buy it at $48, then you own it. After that, now you can start selling calls against it, say $51, $52, $53 strike, and collect more premium. And if it gets called away, then you sell puts against it. That is called the wheel strategy. But I'm getting ahead of myself here. Right now, we're just talking about cash secured puts. These are very simple transactions you can make. And again, why are we doing this? It's because you are thinking you might want to buy a stock, but you're not 100% sure. You think it's a little bit too expensive, and you would be willing to buy it for a lower price. And for that obligation you take on, you should get a nice premium for that. So that's something to think about. Take a look at stocks that you might want to buy. I like to do these usually in stocks that are $40 or $50. It just seems like a nice price for me, for my style of investing. And the premium they pay is fairly good. Obviously, if you're doing this with an Amazon, you're going to get a lot more premium, but there's also a lot more risk there as well. The final problem / option strategy, the third one here, is I've missed an up move, and I'm sad that I did not participate in the move that we just had in a stock. I was thinking about buying it. I didn't have a cash secured put. I sold against it. I wish I did, but I didn't. It continued to go up. I didn't buy any. I didn't buy one share. I didn't buy 50 shares, nothing. Now I'm kind of sorry as the stock continues to rally, and I am missing all that upside. I don't want to jump in when it's super high and be a fool that just kind of jumps in at the top only for it to maybe turn around and lose money. So there is something in the middle that sort of puts the first couple things that we've talked about together in one strategy, and that's called a risk reversal. There's a few ways to do a risk reversal, but the idea with a risk reversal is that you want to capture the upside, so you buy a long call. You buy an upside call on the stock that you wish you had gotten into, slightly higher, either at the money or slightly higher above where it's trading at. You buy that, and that's part one. Part two, which is kind of cool, is you combine it with a cash secured put. You're basically selling a put and you get a premium for that. And what's kind of neat is if you structure the trade properly, you can drag around the calls and the puts, at least on my platform. I think you can do it on many others like TD Ameritrade and Tastyworks. You can make it so the transaction doesn't cost you a thing to get into. It's kind of a fun little game I like to play with myself. And what I'll do is I'll sell an out of the money put, collect a premium. Let's say that premium is $50 again. I will also then buy a call, an upside call that also happens to cost $50. So I'm paying absolutely nothing. And what am I ending up with here? If the stock goes up, I profit from that long call that I made. No questions about it. I'm not owning the stock, but I have an option, and I will sell that option for a profit in the future. If the stock goes down, it goes down to a price that I am willing to purchase it at. Again, in that Pfizer example, if we did this with Pfizer and it's trading at $50 and my put that I sold was $48, I will end up being assigned if it goes below $48, and I'll buy it. Didn't cost me anything to enter that trade. I took a shot at getting some upside return. It didn't go up, but it's a stock that I like. I'm willing to own it. And this is just a way to participate for not a lot of money, actually for no money, if you structure the trade correctly. You can also get fancier. Instead of selling a upside call, you can do a bullish call spread, which will also help you lower the amount of money you need to spend, or even collect a premium to enter this kind of trade. Imagine that. You get paid to participate in trying to go long Pfizer. Not for free, but you might get paid $50 just to do this. So that's pretty cool. Obviously, there's risks there. The risks, again, are that the main risk with this one, the risk reversal, is that the stock goes down so low and you have an obligation to purchase it or buy yourself out of that contract at a loss. That is the risk there. And that's kind of why I like stocks that are $40 or less, because I know 40 going to zero is better than, say, like an Amazon going to zero and me having, which of course we're going to need black swan events for these types of things to happen, but there's always that risk. There is an outlier risk on everything that we're doing here, but generally you can take a look at the probability of profit on many of your platforms and kind of see, if you rolled the dice a million times, what percentage of the time would you make a profit or a loss? And so those are really fun. Again, so the three problems that we are solving for, just to summarize: a stock that you own that's going nowhere, that you want to continue to hold, take a look at covered calls. Number two, you're thinking of buying a stock, but you're not quite sure you really want to own it, or you think maybe it's a little bit expensive. Take a look at cash secured puts. Third problem you're trying to solve: you've missed an up move in a stock. You wish that you could have participated in this rally that you still think has legs. Take a look at a risk reversal. Okay, I hope I've helped with some ideas. And the reason I bring this up and frame it this way is because when we're learning about options and we hear, oh, you should do a covered call, or you should do a cash secured put, or an iron condor, or a butterfly, I like to think, what problem am I trying to solve, and what's the right strategy for that particular situation I'm in? And that, to me, for me personally, makes the options trading strategies much more helpful, make a lot more sense. I'll throw in another free one for you today. I didn't plan on talking about it, but real quickly, is an iron condor. This is a stock. The problem, again, is that you don't own the stock, but you see something in a range. It's range bound, like the Russell 2000 for 9 months of the year, kind of going up, then going down, then going back up again, then going back down. Now, it recently did break out of that consolidation that had been going on, but for the longest time, maybe after 1 or 2 months, you say to yourself, gosh, it's in the middle here. I don't see any sort of big changes coming up. So take a look at an iron condor. And what an iron condor is basically a bullish call spread, a bullish put spread and a bearish call spread sold together. You get premium, and as long as the stock stays within the boundaries of your iron condor, so if this was Pfizer and we sold a 20 put and a 60 call, you just need Pfizer to stay around 50 or so between now and the end of the trade, and you will make profit. You'll make a little bit every day, and that little bit that you make every day is called theta. I like to make theta decay work in my favor. Usually when people buy options, they're getting less and less, weaker and weaker, less money every day. But with selling option strategies and something like an iron condor, you're getting paid every day. So think about that. Where else are you going to get something like a 10% return daily interest on doing a trade? All right. Another thing that I wanted to talk about today was pairs trades. Now, that's P-A-I-R-S, not the fruit, like a pair of socks. And this is not my wheelhouse. I am not an expert in pairs trade, but it's something that I'm teaching myself and trying to learn about and trying to get better at. Another name for pairs trade, which is really fun if you want to tell your friends at your next cocktail party, correlation arbitrage. That's fun to say, right? Yeah, I was doing some correlation arbitrage on the Russell 2000 and the NASDAQ. That's a very popular one that I believe a lot of hedge fund managers do. And what we're doing is we're buying one item in a pairs trade and we're selling the other. You want to find items that are known to have a decent correlation, something like 0.75 to 1. What that means is that since the beginning of time, if you will, these two stocks or ETFs have traded very similarly together. They sometimes veer off course, and that's kind of what happened recently with the Russell 2000 and the NASDAQ. They do trade in tandem quite a bit and have a decent correlation, but it seems like perhaps they might be breaking down in that number. So you're essentially trading the correlation. And what I've been doing is I've been going long the Russell and short the NASDAQ. And I've been doing this by buying IWM and I've been selling QQQ. Now, it's not exactly that simple because QQQ costs more than IWM does. So what you need to do is buy a little bit more IWM than one share to get up to the price of one QQQ at the time of entry. And I'm serious, I'm just doing this with one share of QQQ. I'm shorting QQQ, one share, and I'm buying like 1.25 IWM. And I'm letting them fight it out. And it's entertaining. And it doesn't cost a lot because you're sort of netting out the entire cost with one going long, one going short. And what you're looking to do is you're looking to profit on the spread. And that is the distance between the two prices as they get wider and wider or converge in other scenarios. You can do this the other way too, where something is very correlated and you're looking for it to become less correlated. You just have to reverse the buying and the selling of the entity. So I should probably write up a post on this and put in some diagrams because I don't think we're going to be able to do it justice completely on a podcast. But my point here, and I have a few more, is that I'm learning to do these pairs trades and I'm doing them with very small amounts of money. Again, one share of QQQ and 1.25 shares of IWM. And I'm watching them. If I am able to get decent results, I'll start to scale up, maybe to 2 shares, maybe to 5 shares, maybe to 10, maybe to 100. But right now, while I'm learning this and following some of the experts that I like to follow and learn from as well, I'm always learning every day. I'll do it with small amounts and just kind of learn. And it's kind of fun, especially not that the market right now is boring by any means, but sometimes you've heard the term watching paint dry. There's some days, weeks, months, even years that can be like that. So this is kind of another opportunity. Think about some ETFs or stocks out there that you feel are very similar. One that I will probably try in the future is an airline one, Delta and Southwest Airlines. I don't know which one I'm going to go long yet. I don't know which one I'm going to go short. But what I will do is say, let's take maybe $500 on each side. I'll go long 500 SWA and I'll go short $500 in Delta, and I could reverse it, but I'm just picking a number here. And with fractional shares, you can totally do this kind of stuff with fractional shares now. So there's no what we used to have to do before fractional shares is buying way more than you needed to figure out the ratio. So you would have to buy like 10 QQQ or 10 IWM and 7 QQQ or something like that. Now with fractional shares, you can do it with pick one share as your basis, and then the other item that you're shorting or going long. Just figure out, do the division and the calculation, and figure out 1.x shares is what you need to keep it balanced when you enter the trade. Another really important rule with these things, if you're going to try them, is when you put pairs trades on, it can be tempting to see one of the pairs go way up and do really well. And then you say to yourself, well, why am I still shorting the other one? Let's just take that off and let the other one rip. That's kind of a no-no. You can get into a lot of trouble doing that. So without going into any detail on that, the rule that I follow, and we can talk about this later if listeners or premium members have questions, is with pairs trades, you put them on together and you take them off together. One of the things that pairs trade lets you do as well is extend the duration in a trade. Let's say you want to do notes, 10-year notes, and you want to do 30-year bonds, and you want to trade that spread. Well, let's say I think 30-year bonds are going to go down. I'm either right or I'm wrong, and I'll know pretty quickly. If I do that as a pairs trade, and I combine that with the going long the 10-year note bond, I can stay in the trade much longer while the probabilities and correlations kind of work themselves out. And perhaps in a month or two, one of them will exceed the other by enough that there is a profit there in that spread. And so that's the hope. And so these allow you to stay in the trades much longer than you would otherwise be able to let kind of the probabilities and the correlations work out. One more, and this was brought to my attention by a member, which was kind of fun. I typically don't get into these leverage 2x, 3x, 5x ETFs, but there were a couple that were brought to my attention that I had not heard of for natural gas. One is BOIL, BOIL, and the other one is COLD, KOLD. And you can probably guess which is which, but the BOIL one is the 2 or 3x natural gas leveraged ETF, and the COLD is the exact opposite. It's the short ETF for natural gas, 2 or 3x leverage, the same amount. Unfortunately, these two are not exactly the same price. It'd be nice if each of them was $5 so I could buy a BOIL, sell a COLD, or sell a BOIL and buy a COLD. They're not. So you do the math, you figure out the ratio between them and adjust. I can't remember which one was more expensive and which one was cheaper, but this was a fun one just to kind of go. And I did make a few pennies trying this, and with no fee commissions, you can do this all day to your heart's content. Obviously, there are some tax consequences if you're doing this in a taxable account, but still, this is a great way to learn. I had fun doing this one. I have had limited success with the notes over bonds, but I will continue to try those because per my understanding, we are at a very interesting time where the spread is ripe for going back in the other direction than it was. So we're at extremes right now, so to speak. And so these trades can be profitable if you enter them at the right time. Anyways, that's my update on some of the pairs trades. I will not be sending these out as hot trades until I am well versed in them. Still have a lot of work to do and learning about how they work, but they are fun, and these are some very inexpensive ways to kind of try your hand at a pairs trade. So if you decide to try one and you find a good vehicle, let me know. The one other area you can do a pairs trade in is take a look at any one of the spider ETFs. Let's say XLE, Energy. Pull out one of the big components of XLE, Energy, let's say a Chevron, and try a pairs trade with those. You're basically trading you're trading Chevron against its index of energy peers. And if you think Chevron is going to outpace XLE, you could go long Chevron and short XLE. That's just an example. It's another place to look. But yeah, airlines, Delta, Southwest. You could do the Treasury, bonds. And then I've also done the rates themselves in Tastyworks. They let you trade not the bonds, but the actual rates, which is kind of interesting and incredible. And that's a topic for a different show. All right. So last topic that we have for today are some mobile apps and sites that I like. One of the apps that Bob brought to my attention several months ago that I hadn't really taken advantage of was an iPhone app. I believe there's an Android one out there as well. It's called Stockmaster. And it's basically kind of the Swiss Army knife of stock apps. It doesn't trade, but it does show you everything, and I mean everything you'd want to know about a stock. It has very nice charting, and you can look at lots of different intervals. It's got dividends, earnings, news. I mean, all of the stuff you'd expect from like a Yahoo Finance type of app or like a marketplace. But it's also got a lot of advanced features, and one of my favorite features, I've never found an app before that lets me see probably 20 or 30 different stocks all together on my iPhone, but like the daily view of the charts all squished together. Just it's amazing. I can take a look at my favorite cryptos. I can take a look at one of my portfolios, stocks that I'm watching, and actually see not just are they up or down, but I can see them on a daily, weekly, monthly, yearly graph all at the same time. Yes, you can do that with TradingView, and yes, you can do, there's so many different app websites that let you do that. But I haven't found decent mobile apps that let you see all of those graphs all at the same time. I'm going to say 20 of them, but it's basically a grid. I think it's 2 wide and maybe I want to say 10 down, so something like maybe 20 different graphs all on one view. It is tiny, and you're going to need bifocals or good eyes to see them, especially if you have a smaller phone. But it'll do what you need in a pinch, especially if you're not at your computer, or if you're at your computer and you just need kind of a different screen to kind of see a few different things going on with your favorite stocks that you're watching. I upgraded this month, and that basically just removes the ads and gives you a little more real-time data, lets you have more stocks in your watch list, and removes the ads, which is nice too, because the ads take up a little bit of space on the screen and I tend to hit them accidentally. So upgrading's been fun. It's $10 a month, and see how much I use it, but so far I'm liking it. It also does push notifications, not just for stock, hit a certain price or went below a certain price, but you can do daily percentage increase, decreases. You can do MACD buying signals. You can do RSI over 50. I mean, you name it. It has got alerts for every different type of indicator out there. You can't combine them like the MVP Valhalla indicator, but at the very least, you have some options there that are very easy to just quickly add, fire and forget, and just kind of move on. So later, and you can put a little note to yourself too. Oh, I was waiting for this to go over the 50 RSI on this stock. Now is a good time to enter, that sort of thing. You can put little notes to yourself. It also has screeners, and it will screen not only by these technical indicators, but also the candlesticks themselves. So you can look for your favorite, hammer, inverse hammer, or a doji or a gravestone doji, whatever you're looking for. You might be able to set an alert on those candles showing up. Still learning a little bit about how to tweak it. I'm not that advanced yet, but it's a really cool app, and check it out if you have a chance. So that is where we will wrap it up here today. If you're still here listening, thank you very much for giving this podcast a chance with just Jerry today, flying solo. I want to remind you that we do have a Black Friday sale going on for 50% off your first month of Money Vikings Premium. The code for that is GOBBLE50, GOBBLE 50. And what you'll get is time with myself, Jerry, Greg, Bob. You'll join our Discord. You'll be able to participate with us in the bonfire. You'll get many, many, many weekly newsletters, Greg's awesome articles on not just trading, but all kinds of dividend-paying stocks and REITs in the healthcare industry that I didn't even know about till Greg brought them to my attention, that are paying amazing dividends right now. Lots of very interesting things there going on. Greg also likes to write about keeping your body fit and healthy, meditation, your mind, which is something that I don't think anyone would argue with me that you need to be healthy and thinking clearly in order to trade successfully and invest successfully. So if any of those things interest you and you want to learn more about those, feel free to check us out on YouTube. We have a YouTube channel. If you found this, we have a podcast. We're writing some articles on Medium, so you can search for us on Medium as well, MEDIUM for Money Vikings. And we're on Twitter, we're on TikTok, we're on Instagram. And if there's other platforms that you'd like to see us on that I haven't mentioned, please let us know. Facebook too, of course, now called Meta. We're on there as well. So please follow us, like us, tell your friends, help us out. And I hope everybody has a wonderful trading week. So take care.